Well, hi everyone, Sean Humphries here. Welcome to All Things Retirement. In this installment, we're going to talk about successful stock investing. We'll continue the conversation, and specifically, we're going to talk about the hidden influences. Those hidden influences, those things we're not aware of that sabotage investment success, particularly when it comes to stock investing. So you'll enjoy this discussion. Now, if you're new to this channel, make sure you hit the subscribe button. We're posting content all the time, quite literally in all phases of retirement, whether you're planning your retirement, transitioning to retirement, or already retired. There's some great content that we'll be posting. So again, make sure you hit the subscribe button. Now, this is a very important topic. Successful stock investing is critical to retirement success, particularly in the environment that we're in now, where interest rates are so low and it's so difficult to find yield. And yet there are forces that get in the way of us achieving our goals, in particular for our stock portfolios or our growth portfolios. So where we're going to start in this discussion is on the cycle of investing. This is a great illustration of what we go through, and we all can say, I'm logical, I take a methodical approach, I'm not going to let my human nature get in the way of making good, solid, logical financial decisions. And maybe that is you, but that's not the majority of people. But we'd like to think that we make logical decisions, but we're really influenced by this cycle. So stock markets tend to go in cycles. There's economic cycles, there's political cycles, but particularly economic cycles. When the economy begins to do well, the stock market tends to follow suit. In fact, it even begins to do well in advance of real recovery. So if asset managers, investors feel that the economy is in a situation where the conditions are ripe for recovery, you'll see the stock markets begin to move up even before the actual data confirms that. So in the early phase, you see some optimism and excitement by retail investors, and then you hit this point of euphoria. So where a lot of investors, retail investors, jump in is at the point of euphoria. And then all of a sudden, eventually, we get this point where markets are going down, there's anxiety, denial, fear, and eventually, if it gets bad enough, you see despondency, panic, and capitulation, where people leave the market. So the main reason many investors underperform is they get caught up in this cycle, this emotional cycle of investing, and they tend to buy at the higher end of the market because that's what's driving a lot of the optimism and euphoria, and then they tend to capitulate or panic and sell at the lower end of the market. And it's a constant cycle that continues cycle after cycle after cycle. So we need to almost sort of, stop at the door, recognize this is a reality, and then part two of that, which is what we'll be doing in this video series, is talking about process, steps, strategies that we need to put in place so we don't get caught up in this cycle and make bad decisions. Okay, so again, that's why you want to make sure you subscribe, because you don't want to miss the future videos that unpack those strategies. Now, tied to that cycle is just emotion. So human nature, psychology, emotions get in the way of this. Many of us realize that when we go through emotional periods, there's reduced cognition. We just don't think as well. We go from, surveying the landscape, gathering information when we're in a more relaxed state. As stress begins to build, we don't take in the full scope of information. We just get worse and worse at making decisions. That's not a good recipe when it comes to stock investing. And so that anxiety that builds up through those cycles leads to reactive decisions. So we make poor decisions, and the probability that we're going to blow up our performance increases over time when we're caught up in this cycle. So again, we need to realize that it's there, it's real. We're human beings. We're not just computers. And so we need to take this into account when we're building portfolios. Now, the other thing we need to take into account is the psychological influences that are always at work behind the scenes. So let me go through some of the main ones. And these are there. They're real, and they are subtly driving us in certain directions. So the first one we'll talk about is loss aversion. So loss aversion is essentially, it's basic human nature to weigh loss far more than we weigh gain. So 1 unit of loss, the equivalent might be 2 to 3 units of gain in terms of how we weigh it emotionally. It's not logical, at least in our current environment, I think, but that's the way we're wired. So we need to understand that, because if we don't, then we may make some poor financial and investment decisions. The other is herding. So again, we all know, that's part of the environment that we're in. We mimic the thoughts and the actions, whether they're rational or irrational, of a larger group, of the group that's around us. Now, it doesn't mean the herd's wrong necessarily, but we need to understand that that pull is always there. And so when you make an investment decision because everyone else is doing it, make sure that you're doing it because you've done the research, and your own research and guidance and expertise from others confirms what the herd is doing right now probably is the right decision in the moment. We also have anchoring. Anchoring is very powerful. So that's when we make a decision and that decision gets anchored into our psychology and emotions because of the events. The emotion is the anchor. So I make an investment decision and it goes really, really well. And so I anchor to that decision or that specific investment option. Now, it may have done well because of luck, just timing, not because of my expertise. I may lack the humility to understand that, but often these events are purely just timing. And so we make a decision, it's anchored in the positive, and now I fall in love with that decision. But you can have the same investment opportunity anchored in a negative way, a negative emotion. Doesn't mean the investment was necessarily wrong, but the circumstances around making that decision were negative, and that anchors you in a negative way to that investment option, and it keeps you from making rational decisions on your portfolio. Overconfidence. If there's one thing I'd say to people when it comes to stock investing, have some humility. You're probably not the smartest person in the room. Recognize that. And overconfidence when it comes to investments, your ideas, your perspective can lead to all kinds of problems. Like I said, I've been in the business for over 30 years, and I've seen overconfidence and a lack of humility blow up portfolios so many times. So it's really something we need to understand as a bias in our decision making. Framing, that's about making decisions depending on how information is obtained or presented. It could be the source of the information, it could be the images or surrounding that information. But again, how information gets packaged to us can influence our decisions. Doesn't mean that the position of that message is wrong, but we need to know how the framing influences our decisions. And then recency, believing what's been happening lately will keep happening. Well, the market's done well the last 3 or 4 days, so I'll jump in. Surely it's going to do well the next 3 or 4 days. That might be the case, but are there analytics you need to do to kind of reconfirm that that's the right decision for you? Now, we just need to be mindful, this slide has lots of text, but really what it's saying is we're impacted by headlines, we're impacted by our emotions, we're impacted by our psychology. Those are all things that are not directly related to the specific investment strategies we're taking a look at, but they're powerful in terms of how they influence the final outcomes in our portfolio. So we too often take the position that, reaching our investment goals is like this linear line that just kind of goes up, when this line probably is more apt in terms of what the process is in terms of goal achievement. The image here is the amygdala, so that part of our brain that attunes us to danger and that flight or fight response is there. It may not be full on bright red, just the siren's on, but we can get minor activation of the amygdala that again creates that anxiety, a little bit of low-grade stress. We may be not making the decisions logically all the time. So we just need to be aware that when we're looking at our portfolio and we have our thoughts about the portfolio in any given moment, before we take action on those thoughts and emotions, are they logical? Do they make sense before we act on them? Too many people just act and then regret that action after the fact. I wanted to end with just a couple of slides here. This is not that long ago. So this is Forbes magazine. This is back in March of 2020. We're just now beginning the whole COVID experience. And this headline says Dow plunges 3,000 points as Trump says U.S. may be headed for recession. And literally just, a few weeks later, we've got this headline, April 10th, in the Wall Street Journal. Dow soars more than 11% in the biggest one-day jump since 1933. And this is the ping pong effect that we see. So the headlines now are really intended to be clickbait. There's a lot of fragmented reporting, and we're just getting whipsawed back and forth. I'm not saying you don't read the news, right? I'm not saying you shouldn't pay attention to this information, but what I will say is do not allow headlines to be significant influencers about how you look at your portfolio. To be a successful investor, you need to have process and systems and discipline and research. And I would add, for many people, good coaching. If you don't have those things, you're going to succumb to these headlines. And it's going to create drama and emotion, and it may lead you to make some bad decisions, right? So don't use headlines. BNN, Business News Network, and Bloomberg, it's all great stuff. But I can't tell you, and I consume the information as well, but I can't tell you how many times if you'd acted on what the talking heads are talking about, you probably wouldn't have made the right decision. No one really knows what the future is going to hold when it comes to stocks. And what we do know is there's going to be cycles. And we can't allow those cycles that generate emotion drive the decisions. And this final slide in this presentation is a good example. This is the S&P, the broad U.S. stock market, 500 largest stocks trading in the U.S. And this is now trending in February of 2020, and then COVID starts hitting. The market begins to respond to COVID. And from its peak here down to the bottom, the market fell 33.8% over a very short period of time between February 20th to March 23rd. Now, if you look at the market from March 23rd on here, particularly this 23% rally here, what happened was, and no one knew this was going to happen for sure, but governments really pledged strong fiscal support, and central banks pledged support as well to support credit markets and financial markets. And the rest is history through 2020. So the U.S. stock market had a significant rally, and from the trough, it finished 70.2%. Now, how many retail investors were buying at this point? I'd say not too many. We had clients doing that for sure. But a lot of people were selling here, and they capitulated. If you go back to that cycle of investing, that's what happened. They sold through this trough, and they didn't go in here, and they waited and waited and waited. And maybe only now they're beginning to think about going back in. Is this a good time? I'll let you be the judge. There are opportunities potentially. The purpose of this, video is not to give you a market recommendation, but just to kind of underscore the cycle of investing that we've been talking about. Well, it's my hope that you found this particular presentation helpful. Again, make sure you hit the subscribe button so you don't miss any of the ongoing content that we're creating, in particular the series of videos on successful stock market investing. As well, in the show notes, you're going to find links to all kinds of great content, links to our retirement coaching service, links to our website, and our blog posts. So make sure you take a look at that description content and links, and you might find something that will be helpful for you as you journey through your retirement planning and as you strive to be a successful investor. All the best.